Hello and welcome to Real Insights. Today we are talking with Mike Toft, Senior Fund Manager at Octopus Real Estate.
Hello Mike, welcome to the Real Insights podcast.
Morning Sam, thanks for having me.
Pleasure. So this episode is about UK care homes, an area that you all know a lot about, but maybe not as familiar to some of our listeners. So maybe if you start off with what Octopus Real Estate does in the care home space and also your role specifically.
Yeah, no problem, Sam. So yes, as you say, I work at Octopus Real Estate and I head up the care homes team in the real estate division. I joined Octopus about 3 years ago. I'm a long track record in real estate investment, but really grateful to be supported by a high experienced team that's been investing in the sector for a long term. And what we do, we run a strategy that's specialising in the elderly and specialist care sector. It's called Octopus Healthcare Fund. That's been in existence since 2017. Before that, it was a different structure that was converted. So we've got long track record and experience in the sector. Currently, that fund is about $1.5 billion in size. That's 100 plus care homes. That's about 7,500 beds once all our construction is completed. So significant scale in the marketplace. And we're backed by institutional capital looking to get that special expertise, how they invest into the sector.
Mm-hmm. And just to clarify, the real estate side, you're entirely leasing these properties to specialist operators who are dealing with the elderly residents and the care and that kind of thing?
Yeah, correct, Sam. So we are effectively a landlord fund. We're granting triple net FRI leases to occupiers for 35 years, so long-term relationships with the operators. We're not taking any operational risk ourselves, so we are letting the homes to the operators. We try and form those very close relationships through our clinical teams, where we have nurses who are interacting with the operators on a daily basis, making sure we can quantify and identify and address any risks if we have to.
Right. And there's a lot of jargon in commercial real estate, I think, across all sectors, and I imagine there's a lot of sort of specific jargon to do with the care home or elderly care. How do you, if you can, divide care homes into sort of broad categories of types of real estate?
I think acronyms are probably even getting worse in the real estate market. But yeah, we do try and break down the categories within our portfolio. And I think if you take a step back in terms of look at what we're trying to do in the marketplace is build care homes that are fit for the future. So the specification is right for those long-term agreements. A lot of the built stock in the UK, the majority of the stock in the UK was built last century. So there's a bit of an obsolescence. There is an obsolescence issue growing in the market. So we're trying to deliver quality care homes that meet our specification KPIs that allow the quality of care to be provided by the operators. We tend to classify the homes within our portfolios ourselves as mature, fill-up and transitional. So once you open a care home, it may take sort of 3 years to reach trading maturity.
Okay.
That's filling up slowly on a managed basis to get to that sort of 92% occupancy, which we consider full occupancy. Mm-hmm. We have fill-up homes that are obviously in that position from opening to reaching maturity, and then transitional homes that are trading under their potential that allows us to actually, with our expertise and the deep knowledge in the team, lean into those areas where there are concerns, help operators be the best they can be. Fundamentally, the way we look at the market in each of homes in our portfolio, if the individual residents are receiving the right quality of care, everything else should take care of itself.
Yep. Okay. I understand Octopus broadly looks at ESG, clinical and financial as sort of their overall underwrite for a new care home. What are the challenges within each of those categories broadly?
Yeah, really good question, Sam. And those are the three lenses we look at the market and look at any opportunity, and we give equal weightings to those areas. So, through the financial lens, obviously we put a lot of work into working with our operators, developers, when looking at opportunities. They can a care home operator provide a business that will support them financially? Can they make suitable profit from that location? Then we know that the right provision of care will be provided underneath that. Obviously, from a financial perspective, we are looking at operators' financial strength, their business plans. What we tend to do as a team, as a fund, we don't chase yield and covenants, so we're just not looking for big balance sheets. We use our expertise to underwrite what we call SPVs, so operators who have the right clinical financial frameworks in place, but they may not have the balance sheet to support themselves. It may put other less experienced investors off those opportunities. So fundamental to us is then looking at the financial makeup, the business plans, the frameworks that the operators put in place. Do we support what they're doing? Do we have the right frameworks in place in the right locations that will support a profitable business looking forward? Mm-hmm. And it's really key to having that deep expertise in the marketplace to be able to underwrite those opportunities. From a clinical or a quality perspective, it's all about knowing our operators as well as we can do. And I say we give equal weighting to these lenses. If our quality assurance team, and we have 3 nurses sitting within our team, really lucky to have that expertise in-house, and we wouldn't feel comfortable operating the sector without that. They are key to our underwriting provisions. So if they have concerns over an operator or an opportunity that we're looking at that may pass ESG and financial tests, we won't take any further. Once a home and an operator is within the portfolio, they're fundamental to maintain that relationship, being our eyes and ears on the ground, assessing any risk, identifying any risk, then leaning into that and helping the operators. So really, obviously, the concern there is that I talk about 7,500 care beds. You can't get it right. The operators can't get it right all the time. So it's making sure that we have access to the operators, the relationships there that actually there will be that transparency, sharing of information that we're aware early, and we can help operators be the best they can be. Mm-hmm. And then thirdly, not lastly, is ESG. I touch on the care sector having a building obsolescence issue. We're building mainly because of that, the standing stocks not of a quality in the majority that we would acquire into the portfolio. Our route to the market is mainly through development or funding developers to build quality care homes that meet our criteria. That allows us to sort of push the ESG envelope, really sort of drive towards net zero, make sure the homes are efficient. We're lucky to have Octopus Energy and within this Octopus group that we can lean on to really understand the technological advancements coming through and really and look to introduce us into our homes. So I think from a concern perspective is how quick can we run to meet those net zero targets we've set ourselves is a big challenge there. It's an expensive process, and we've got to look at the homes we have in the portfolio that might need a retrofit. How do we do that on a managed basis? How do we do that in operational care homes, early residents in situ? So there's a lot of moving parts in there, Sam. Yeah. But yeah, as I say, it's making sure that we give equal consideration to those areas, those lenses. Where they cross over in a typical Venn diagram, that's OHF in the middle. So they need to pass all those tests before we'll take an opportunity further.
Yeah, the ESG credentials of these newly developed buildings is really interesting. I would like to talk to you a little bit about some of the challenges in developing, but just maybe picking up on the financial piece, because I guess with a 30, 35-year lease in other asset classes, there's a lot of value in that lease, and the investors might be saying, I want to see some credit quality. Mm-hmm. I guess you're saying that, well, this is an SPV covenant most of the time, but we are fundamentally underwriting in a way the operations of that business, and that's where we're getting comfortable with the value creation in the lease. So I think it's a really operational asset type that you're investing into. Yeah,
right? Really key point, Sam. And it's we're not taking the operational risk, but we're working with our operators to ensure that they are providing the best service. We have a diversified portfolio. So we have 34 operators in the portfolio, and we do have some of what we call the tier 1 covenants, have the big balance sheets. But the majority in our sort of strategy really is focused on the SPV plus elements of the market. And what we want to do is identify and grow with the best-in-class regional operators. Mm-hmm. If we can do that, we get that deep understanding, we get that comfort of what we're doing. Of course, we have provisions in the leases that there has to be information shared by the operators that gives us that clarity of what they're doing on the ground. And we do have good examples in the portfolio. We've grown with SPV operators from their very first home up to 15 homes, and it's really that growth and supporting them. We really think is our USP, is our expertise in the market that we can discern. But there's reputational risk in the market. There have been financial failures in the past, making sure that we're cognizant of that and we've got the provisions in place to identify that.
Yep. So maybe just touching on the development side.
Sure.
I imagine there are some challenges in terms of the planning process, construction.
Yep.
I think, it's really evident that there is an aging population. There's a lot more demand. But if we look at supply, it's kind of been reasonably flat in terms of new beds registered, old, as you say, obsolescent beds being deregistered. Can you comment on some of the challenges in the development process?
Sure. Well, you raised a key point: is the planning process is still slow in the UK,
Right.
and there doesn't seem to be many signs of that improving. There's a lack of staff in the local authorities and planning teams. That aside, assuming we do get the developers are able to get the planning consents, development has been difficult over the past 18 months. We've seen the economic cycle yield expansion, and we have seen construction costs rising also. So there's been pressure on the profit margin for developers being able to facilitate development of new care homes that meet our criteria. We have still been funding the construction of care homes throughout that period. We have had to find routes to the market where perhaps operator developers form JVs that the developers can benefit some of the future cash flow of those businesses to replace profits they would have made. And I just think it's an economic cycle. Some developers will have overpaid for sites, which make their financial calculations look a little bit thinner. So just as we move through the cycle, some developers may have to accept less profitability. They did have good times at the other end of the cycle. So yeah, it has been more challenging. I think what we have seen is in the private pay market, so the area of the care home sector we tend to target our underwriting on, is that the operators have been able to increase their fees to offset cost pressures that they've been experiencing. So that has helped developers have been able to charge agree a little bit more or a higher rent that actually feeds into their appraisals. So profit margin's thinner, but development's still happening.
Yeah.
We'd like it to be quicker. We can't keep up with we can't turn the supply on quick enough to keep up with the demand. You touch. We've probably got balance in the UK now. If you look at just purely on a number of bed spaces, the quality is an underlying issue. But it's when you look at the demographic growth moving through this century, where it's up to 300% growth in the 85% cohort, and you look at just in this century alone, it's been a relatively neutral, of probably a net loss of beds over that period. So we need to change the dial. We need to have that curve increasing.
So you mentioned private pay.
Yeah.
Is it right broadly that your bed in a care home is either funded entirely by you or your family privately, or some sort of public assistance to varying degree that's means tested?
Yeah.
And is that broadly how that works? Yeah.
So if you look at the UK sector, roughly speaking, in terms of occupied beds, it'll be 50-50 between publicly funded and private funded, maybe slightly skewed to more public, but then the private rate's a little bit higher, so it probably on a financial basis balances out at 50-50. Yes, you're right. There's means testing where you will qualify for local authority funding if your net asset base is less than roughly £23,000, so quite a low base. There is an imbalance in the market. Private pay residents are effectively subsidising local authority funded residents. There's a bit in the middle where residents will qualify they'll pay for their fees, but will qualify for top-ups. So there's some sort of additionality there. And it's not a universal story across the UK, but you will see in some jurisdictions local authorities paying up to the private fee rates just because there's such a lack of care homes in that jurisdiction. But in other locations, you will see local authorities only prepared to pay up to maybe £800 a week versus a private pay package of £1,300 a week.
Right.
So that's imbalance, and those private pay residents who are receiving exactly the same care as local authority residents are effectively subsidising. So there does need to be some sort of acknowledgement. Local authority public funding is obviously tight, particularly at the moment, but there does need to be the private pay market has been part of the solution to really galvanise the sector, and the local authority public operated care homes have basically been withdrawn from the sector. But there is an imbalance at the moment. We'd like to see equalisation rate. We're trying Octopus Real Estate to engage with local authorities, NHS trusts, about how we can work to deliver care homes on a basis that could be supported by local authority fee rates. Mm-hmm. But there does need to be acknowledgement from the public sector that they're not providing enough funding to social care. I know that's a promise that several governments have made. They're going to find a solution. It's difficult. There's a lack of funding. But we want to be part of that solution. How do we find an equalisation, shall we say, of fees where the public market, the private market's not subsidising the public market quite as much as it is at the moment.
Yeah, interesting that's what's being sort of forced upon the private pay.
Yeah.
Is to subsidise some of those local authority sponsored beds.
Yeah.
Is it a fair characterisation to say that the sort of the new build better stock would tend to be predominantly private beds, or sometimes the local authorities will also pay for those?
I'll give you a politician's answer. It's not one size fits all, actually. We will see some care homes in the portfolio that are 100% privately funded residents. We'll see some care homes, particularly during COVID, where they took block contracts, operators may have been 100% publicly funded. And our portfolio at any one time, and it changes because we don't stipulate how operators let their beds, that's entirely up to them, that it could be 70-30, that sort of split in terms of the majority being privately funded versus local authority funded.
And during the COVID pandemic, for example, was it some of the homes that had more public beds than private maybe did better because that public funding was still coming through?
I think really you've got to look at when you look back at COVID, it was incredibly difficult at the outset, and there are obviously some very negative headlines. And looking back at the government insisting that infected patients should become residents in care homes was obviously was a very negative position. But what we quickly realised, and the sector realised, and this is just not particularly focused on our portfolio, the sector as a whole, the operators, did fantastically during the pandemic. But it's easier to operate a care home during a pandemic when you have a modern purpose-built specification. So within our portfolio, we have 100% ensuite wet room provision. We have key specification targets that must be met, width of corridors, communal space, that allows operators to function better during a pandemic, where you can still provide a high quality of care, but the residents can be segregated if they have to be. So it was really from our learnings where the operators pivoted very well in terms of the latterly in pandemic, some of the safest places to be with infection control measures, just the discipline the operators had, but specification of the homes really came to the fore.
Right, that's interesting.
Yeah.
I think you've mentioned some of the, say, reputational risks, which are clearly high if people forget to give medicine to their grandparents. Obviously, that's very, very, very sensitive. I've also seen several articles. I think there was a BBC Panorama interview with the costs of utility bills going up, the cost of living. Mm-hmm. It's probably putting pressure on the operators in terms of their margin, but in what is a very sensitive sector. Yeah. So how have you, changed any learnings of the way you deal with the operators coming out of the cost of living crisis and the squeezes on margins?
I think that gets to the sort of the crux is it's we want to have those relationships and understanding in the market and have that expertise that we can identify and address those issues. That's why we have a clinical team in-house, that we can get ahead of any risk within the portfolio. We can address it. We can share best practice. We can help rise the quality of the care within the portfolio. I think looking back, bad news sells papers. Bad news in the care sector particularly sells papers. So it does. When there's a bad news story, it does get a lot of coverage. I'd say universally, operators across the sector are performing really well. Yes, there are bad news stories. Yes, investors' memories are long. If you look back at 4 Seasons, Southern Cross, financial failure with over leveraged private equity. So we do look very closely at that from a financial perspective. What's the plan for the business? I would say that vast majority of this care homes are still in operation. So it's really underpinned by that societal need.
Yep.
But I think sort of our learnings as a team is really that relationship we build with our operator developer partners, and whether that's financial, clinical, ESG, it's being prepared to share that best practice so we can all be better together. Collectively, from our perspective, that leads to a better risk-adjusted return, better risk profile within the portfolio. But it's really making sure that we're in touch with the operators, we understand what's going on, they're in a position where they feel they can share any misgivings with us, and just that transparency relationship puts in a better place to all be the best we possibly can be.
The combination of quite a highly operational asset type, but also a long-term lease profile that's inflation linked.
Yeah.
Where does most of the private investment come from?
Sure.
What kind of institutions sort of fit this asset class well, you think?
Yeah, and I should touch on, just sorry I didn't cover in your last question, Sam, is just in terms of financially looking at the operators, that counterintuitive, if you look at the financial information we receive from operators, they're actually in a stronger position post-pandemic and post-inflationary cost of living crisis, because they've been able to stretch that average weekly fee to offset the inflationary pressures they've been coming through. So in terms of institutional investments in the marketplace, and if we look at what we're seeing, who's trusting us with their capital, obviously we're a UK only strategy, so there's quite a lot of UK capital, quite a lot of pension money, insurance money coming into that, but actually over the past 2 to 3 years, a growing global acceptance of the sector per se and the societal need that underpins the operation of real estate, and really that sort of acknowledgement of the institutional sector that it's a specialist operational market that comes with risks. You need specialist investors to advise you on how you access that market. So really pleased to say that it's a global base. We have money within the OHF portfolio from the Far East through Europe into the UK. Obviously, the UK is a small market in a global sphere, so some investors are worried about niche on niche. It's a bit of an education. Some people still remember the reputational risks, have concerns about coming into the sector. So there is a broad educational piece to be undertaken to try and demonstrate that risk-adjusted return. The societal need really underpins the asset class within the UK. And if we look at it now, we've got just about enough care beds, but you overlay that demographic growth, you look at the obsolescence of existing stock, you look at our portfolios 1.5, this is not to throw numbers around, but that could be 2, 3, 4, and we still really wouldn't be solving the problem in the UK. And that's a problem that is out with the UK as well. As a Western society, we are all aging. We need to consider how we're going to fund social care in the long term, and private institutional capital can be part of that solution.
Yeah. I think just one other interesting distinction between the UK and New Zealand, where I'm from, I think Australia and the US, we have a lot more what you'd call senior living.
Sure.
So sort of over 55, but fully functional. You're playing tennis, playing golf, maybe behind a gated community kind of thing. That seems to be lacking in the UK. I think there's some much older kind of senior living type stock that was developed in the 90s. What's your thoughts on senior living? What kind of role can that play in terms of the demographic challenges?
Yeah, I think we really need to look at the residential provision for later living. And at Octopus Real Estate, we actually have a team that specialises in retirement living. So we're one of the biggest developers as such of retirement communities. And I think that is part of, you look at sort of care for the elderly cohort of the population, care homes aren't the solution in isolation. There's a broad spectrum of care. So whether it's from retirement sort of 65 plus and say playing golf, playing tennis sounds very nice, that does take pressure off the NHS, does take pressure off the built environment, freeing up homes for younger families. But then that bridge between care homes, elderly care, which is societal need, which is it's a needs-based, the residents can no longer live independently at home, but it's cognizant that we're only part of a much bigger picture, that there's domiciliary care that forms part of that. And we've got to be, the whole sector's got to be a little bit more joined up, Sam, to be honest. But you underpin that in terms of, yes, there are changes taking place in the marketplace. We are evolving, looking at overseas market in terms of how the retirement and the gated communities have evolved, and looking to find the solution in the UK for that. There are other bits, a piece of the jigsaw that needs to be put into that spectrum to make the whole provision work. Mike,
this was really interesting. I appreciate talking about a new asset class for a lot of people. And it's a really, really interesting one, and it'll be interesting to see how it plays out as the demographic in the UK changes. So thanks for your time.
Thanks for having me, Sam. Thank you.